Right now, the United States government is changing how it manages $34 trillion kicks in debt. There was no emergency announcement, no press conference, no primetime speech. But this quiet shift is already affecting interest rates, bond markets, and borrowing costs across the entire economy. And if it continues, it could decide what happens to your mortgage, your savings, and your retirement. Next. This isn't something happening years from now. It's happening right now. For decades, U.S. debt worked because of one assumption, that global investors would always be willing to buy it cheaply. That assumption is starting to crack, not because America is suddenly bankrupt, but because the rules that kept borrowing painless no longer exist. And instead of saying it out loud, the U.S. government is quietly reshaping its debt strategy behind the scenes. To understand why this matters, we need to go back.
After World War II, the U.S. built the most powerful financial system in history. The dollar became the world's reserve currency. U.S. Treasuries became the safest asset on Earth. For decades, whenever America borrowed more, the world absorbed it. Even after the 2008 crisis, even after COVID, even after debt crossed levels that would have crushed other countries. Why? Because interest rates stayed low. Cheap debt hides problems. Expensive debt exposes them. Here's where we are today. U.S. federal debt. Over 34 trillion baht. Debt to GDP. Around 120% our BAS. Annual deficits. Over 1.5 trillion baht even outside recessions. That alone isn't new. What is new is interest costs. In 2020, the U.S. paid about $345 billion a year in interest. Today, that number is approaching $1 trillion annually. Interest is now one of the largest single expenses in the federal budget, bigger than defense.
And every time old debt matures, it has to be refinanced at much higher rates. This is where the quiet reshaping begins. Most people think governments issue debt the same way forever. They don't. The U.S. Treasury has started making more subtle but critical changes, adjusting the poor maturity mix of new debt, increasing short-term issuance, managing buybacks and rollovers differently, preparing markets for longer-term structural borrowing. Why? Because locking in high long-term rates is dangerous, but relying too much on short-term debt is risky too. The Treasury is trying to balance between not shocking markets, not locking the country into permanently high interest costs, and that balancing act is getting harder every quarter. Here's what almost nobody is talking about. The problem isn't just how much debt the U.S. has, it's how fast it needs to be refinanced.
Over the next few years, trillions of dollars in treasuries mature. They don't disappear. They get rolled over at today's rates. That means even if Congress passed zero new spending, interest costs would still rise. This is called a refinancing wall. Historically, when countries hit this phase, governments have only four options. 1. Cut spending. 2. Raise taxes. 3. Inflate the debt away. 4. Let markets force the adjustment. None of these are painless. U.S. debt doesn't exist in isolation. It's the backbone of the global financial system. If U.S. yields rise, global bond yields follow. Mortgage rates rise worldwide. Equity valuations compress. Capital shifts across borders. Foreign governments and institutions hold trillions in U.S. treasuries. If demand weakens, even slightly, borrowing costs jump. This is why the Treasury is so careful. They're not managing debt anymore. They're managing confidence.
Historically, when debt reaches this stage, a few paths usually follow. One possibility: growth stays strong enough to outpace debt. This is the best case, and also the rarest. Another: inflation quietly does the work. Debt stays high, but its real value shrinks. Or, rates stay elevated, deficits widen, and markets start demanding higher compensation for risk. That's when governments lose flexibility. No crash announcement, no single breaking point. Just slower growth, higher costs, and fewer options. So, what does this mean for you? If interest rates stay high, mortgages stay expensive, credit cards stay expensive, car loans stay expensive. If rates fall because of economic slowdown, your savings yield drops, asset prices become volatile, job security weakens.
Your retirement accounts are affected either way, through bonds, stocks, or both. This is why debt strategy matters. Not in headlines, in household budgets.
The U.S. government isn't panicking, but it is adjusting, quietly, carefully, because once debt reaches this scale, small changes matter. History shows that sovereign debt crises don't announce themselves. They feel impossible until they become inevitable. The real question isn't whether the system changes, it's who's prepared when it does. If you want to understand how these shifts develop, before markets react, subscribe and turn notifications on, because the next phase of this story won't be loud, it will be quiet, and by the time everyone notices, the consequences are already locked in.